Is there any personal values that you've kept yourself throughout this career?
You know, we have a saying in the team, do the right thing for the investors, do the right thing for your employer, and then you will end up doing the right thing for yourself, in that order and only in that order.
Is there any guidance you give young individuals who want to come into the industry?
The very simplest advice is, you know, I invested in a gold mining stock when I was in high school, and I cured myself of that disease forever by losing a lot of money.
Yeah. In very simple terms, what is active, what is passive?
Active is when you have 25 names instead of 4,000, when you have a sort of active share like we do of over 95%, and all that means is that you look very different to an index.
If there's one, I guess, key takeaway that you would want listeners to take away from this conversation, what would it be?
Well, first of all, if you invest, go and buy.
Welcome back to the Zomi Wealthcast, where we speak about the people shaping the world of wealth, investing, and financial intelligence. I'm your host, Jordan, and today's guest doesn't both have a proven results, but also brings a serious perspective to the table. Pieter Fourie is head of Global Equities at Sanlam Investments UK. He is also the lead fund manager for the Sanlam Global High Quality Fund. Under his leadership, the fund has performed a stellar 230% since its inception in 2014, significantly outperforming its peers and the wider MSCI World Index. Pieter is a chartered accountant, a CFA holder, and a 6-time FE Alpha manager, an accolade that is only awarded to the top 10% UK fund managers. In this episode, we'll go beyond the numbers. We'll take a picking into Pieter's personal journey, his investment philosophy, how he and his team identify quality across global markets, and ultimately, what it means to manage money at the highest level possible. Whether you're an aspiring fund manager or someone keen in the world of investments, this is a conversation I would not want to miss. Hello, Pieter.
Oh, Jordan, thank you for that introduction.
No, of course. I mean, if I could add all the achievements, all the accolades on top of that, I think the introduction would have been a lot more longer than that. So it's an honor to have you on the podcast, and I really appreciate you taking time out for this. I mean, Pieter, obviously, like I mentioned in the intro, head of Global Equities, lead fund manager. Obviously, your career doesn't just start like that, does it? It takes probably years of experience. I mean, unless there's other people in the world that are a bit different, where they go straight into that position. But you don't just start there. I think it takes years and years of progression and milestone and mistakes, etc. Could you give us a little insight into, I guess, your upbringing? Were you always involved in finance? Your upbringing, did you have a context of business or finance? Where did it start when you were younger?
Yeah, thank you for the question. From my perspective, I sort of grew up in an academic family. My father was in the law faculty his whole life at a town called Stellenbosch, and so you know, as a student, I was always told that I should pay attention to making sure that I have a very strong academic upbringing. So. With most of my family having a legal background, I was the odd one out. I started getting interested in investments at high school because my dad invested for himself. He introduced me to some stockbrokers at the time, and I started talking to them about what's the best route. So I went the accountancy route.
Okay.
It's a very solid background.
What did you study at Stellenbosch University?
It was called B Accountancy and Honours. I actually enjoyed the tax a lot
Right.
because I think it's an interesting concept how you can put accountancy and legal concepts together in order to have tax efficiency. So I then had this conversation with my dad to say, look, I like the chartered accountancy route and I like accounting, but I really want to do investment. So I spoke to someone and he suggested I do a CFA whilst I was doing my articles at Ernst & Young at the time in the mid-90s.
Could we give a timeline to that? When did you do EY? Is it in the 1990s?
Yes, so studied from 91 to 94, got my honours, then passed the CA exam, the Chartered Accountant exam, and went straight on to a CFA, which back then in the mid-90s was quite not many people did it these days.
And there's not many fund managers that are both chartered accountants and CFA. So
yes, so I think when I look at what that advantage is, we obviously do go through the accounts of the companies we invest in. We focus a lot on free cash flow and how do you define free cash flow. So the accounting background really helped. But it's also a question of, as a CFA charter holder, it probably demonstrates some sort of commitment to get this qualification whilst you're also working. So
Of course.
I think as a chartered accountant, you learn to also prioritize time. If you're looking at potentially thousands of investments, you have to prioritize how you actually can use 20 hours in a day.
Of course. You said as well, so after EY, you finished up there, did your articles, you went straight into CFA. Obviously, you're living in South Africa. Obviously, you're living in the UK now.
Yes.
How did that transition go from EY now into the UK? And if I remember previously, obviously at Stonehenge, and now you're at Sanlam. So how did that all transition?
Yeah, so I did get some offers from the likes of Coopers and Lybrand at that stage, Ernst & Young, KPMG, but I came over, ended up on a spouse visa, which made me more flexible with my working arrangements, and then got introduced to Giuseppe Ciucci, still the current CEO chairman of Stonehage Fleming, and eventually turned out to be my mentor as well. Over the next 12 years. So I started off with the investment division in 1999, a year after I came over to the UK, first in Switzerland, and then formed an investment division for that company in 99, and had a very, very good 13 years with Stonehage.
And then obviously the fund, was it launched in 2012 or 2014 with Sanlam?
It was launched in February 14,
right.
and the strategy started in April of 2008.
Right, okay.
So I carried, when Sanlam started an investment division in the UK focused on global direct equities, they approached me on the back of my track record. And again, you talk about people shaping your career. For Sanlam, very grateful to the then CEO of Sanlam Private Wealth, an individual called Daniel Creeley, gave me investment freedom. He said to me, we will never interfere with your investment philosophy. I think that's a huge competitive advantage. You can choose the people that will be with you. So many of my colleagues with me for 9 to 10 years, in some cases. William's been with us for over 12 years. So the team's been very stable. We live and breathe this philosophy in how we believe we can outperform over time. And that's a great advantage because two of my colleagues, Louis and Hannah, were straight out of university into the team. So that's fortunately or unfortunately, that's all they know.
All that.
But if it's working
not
out,
a bad place. Yeah,
it's not a bad place to be. Yes.
Yeah. That's brilliant. And obviously now you've been at Sanlam for nearly 15 odd years, or below, less than that?
Yes, it's approaching, it's 13 odd years.
Yeah. And still going strong.
It's still going strong. We had no assets back in August 2012 when we started. Great support from Sanlam to build what we have today. We have a very diversified client base today. And we service from retail investors through to large pension funds and family offices. So we're very excited that we've always believed that we don't do hedge funds, we don't do any gearing or options. It's just plain vanilla, great businesses that we're looking to invest below fair value. And what's good for $100 billion pension fund can be good enough for a retail investor.
It's got to tick all the right boxes, doesn't it? Is there any personal values that you've kept yourself throughout this career? So obviously growing up in Stellenbosch, going to school in Stellenbosch, going to university in Stellenbosch, and then obviously migrating across the water to the UK after your time at EY. Is any personal values you've kept to today that is still going through?
Yeah, I think it's important to always realize that if you're doing the right thing for investors, we have a saying in the team: do the right thing for the investors, do the right thing for your employer, and then you will end up doing the right thing for yourself, in that order and only in that order. So that's really a reflection of
the people within the business as well.
The people as well, and also taking a long-term view in what you do. I remember when Stoner gave me a chance in 99, I was just a inexperienced, well-qualified individual, but with no real investment experience. So, someone has to take a chance on your ability. Stoner did that first, and then, Sanlam did that.
Wow.
But then it's really, how can you motivate the people around you as well to think in a particular way? Because the investment industry, as you know, it's ups and downs. At the moment, we're riding the crest
We'll
of the
get into
wave.
that, yeah. We'll get into
But
that.
it wasn't that long where, at the end of 23 or 24, questions were asked why perhaps you're not doing as well as the market. So when you are doing well, that's probably the point where you have to do a lot of intro, looking at yourself and saying, are you still doing the right thing? Do you still follow your philosophy? And ultimately, do you invest in a way in which new investors can also have a good experience going forward?
No, that's a very fair point. Right, so let's bring the Sanlam now. Obviously, you're working in Sanlam Investments UK for 13 years. You're the lead fund manager. What does that mean? As in, obviously, you're head of Global Equities, and you also look after a team of 6 individuals, including yourself. So it's 5 individuals. What's your day-to-day? What does it look like? What's the responsibility of a global fund manager?
Yeah, so I have always been of the opinion that within that team of 6 people, we have 5 dedicated research analysts, including myself. So I think of myself as a research analyst first and foremost.
So basically, roll up the sleeves as well and get involved.
Correct, because and we'll get to why I believe in that so much. And then one member of the team is an investment specialist. That's also our face of the business. She's a portfolio manager because we do both the fund and segregated mandates. And she really sort of runs the business for us from a client relationship point of view as well. You need someone, and that's really myself and some of us in the team. You need a face that can communicate to your investment base what you're actually doing. Why are you doing things in a certain way? Clear communication is so important when we have dislocations like we're having this year. If you are losing a lot less money than the market, is it because of luck, or is it because of something you said to your investors over the last 15 years you'll definitely do, and also the things you definitely won't do as an investor? And we feel that having dedicated investment specialists in the team means that our investors are very comfortable with how we're going to invest, not just today, but also going forward.
And confidence is a big thing, and trust as well, isn't it?
Correct. It's trust, yes.
Going into, obviously, what is your, I think obviously it's probably very sporadic, your task and your day-to-day responsibilities. But could you give a high-level summary of what you do day-to-day?
Yeah, so today, for instance,
on the podcast,
we've had some tremendous rallies now in some of our health insurance companies. So I'm the lead manager analyst for United Health Group. My colleague William also covers Elevance. So in our team, we have what we call basically individuals that can cover a sector within certain stocks. And what do we mean by that? If I cover a name like Alphabet, my colleague would cover Meta. So we can have a devil's advocate for each name that we invest in. So today, our biggest position is United Health. So I'm paying particular attention right now to that stock. Why? Because there's been some news flow on their Medicare Advantage rates that have just been approved and that exceeded the rates that were published in January this year. So the stock's moved up. We still think it's below intrinsic value, but I tend to spend a lot of time not so much on existing names, but always trying to figure out in our watch list of 140 names, as an analyst and also as the lead fund manager, how can I direct our attention to the best possible opportunities? And that
is that an art of delegating as well?
Yes, and delegation is a strong word. I mean, I'd like to lead from the front. What do I mean by that? We do travel overseas. A part of the job I enjoy tremendously, and some fund managers don't believe in management meetings. I really enjoy it. I had some fantastic meetings with Intercontinental Exchange 2 years ago with the CFO on a Friday afternoon. I had some fantastic interactions with NASDAQ and with
Wow.
Chicago Mercantile Exchange, or CME Group as it's known today. So we've built up a lot of confidence in our exchange positions, which have done really well for us the last 3 years. And as an analyst, I take great pleasure from meeting with management, not because I want to be cynical. That's not a good trait to have, but you want to be skeptical. You want to assess if the growth opportunities you see is also what they are telling you.
It's definitely looking more just even beyond the numbers, beyond the financial modeling, isn't it? And actually, I guess, meeting the people who are running the business, because that is a lot beyond the numbers.
Yes.
Obviously, you've got, your team of 6. Leadership is probably a big thing. You spoke about leading from the front. What about mentorship? Do you see yourself as a mentor as well for your team?
Yes. Yes, absolutely. And I mean, some of us have different strengths.
And it's playing off those different strengths,
exactly.
isn't it?
So some of us are just very comfortable to be very detailed, perhaps even more detailed than myself for certain names. Yeah. And that individual, when the stock's working really well, the team understands that whatever's working or not working, it's one team approach. And we try to support each other in that way when things aren't perhaps going your way. However, the way I've set up the team, I personally am not a big fan of investment by committee. We're very, very open in our equity meetings, and everything is discussed, everything is laid on the table.
I'm happy you mentioned that point, because I know a lot of fund managers usually have investment committees or corporate governance or massive oversight or collaboration. I guess, so you're going into, what is that strategy? Is it just an open management or an open field of?
Well, that's the thing. It's not like I'm sitting in my own office. We're all sitting on the same desk, huddled together in an open sort of forum. But what I mean by not investing, we have all those formal committees. We have a risk committee behind us. There's an exco committee,
compliance, risk
compliance,
management,
all of that. And Sanlam's allowed me the opportunity to just focus on investment. But the final investment decision has to be one person, in my opinion, that makes a decision as to what is going to get bought. Take this example.
So do you not tick that or sign that off?
Yes, I mean, I take that final decision. Even though we have a totally open forum in terms of discussing equity investments, we, it's not 6 people putting up their hands, and if there's 4 hands and not 2, that's the stock that makes it in the portfolio.
That speaks massively on the trust of your team, doesn't it?
Yeah.
Obviously, you've worked together for quite a long time now as well. In order to not have like some type of like veto power or veto votes on certain stocks, I think that speaks massively for your team and the leadership that you involve yourself around. I spoke about in the beginning of the pitch about the performance since inception. What does it take to run a high performing fund that has since 2014? Is it just every day you wake up, you love investing, you love stocks? What is it?
Yes, I do think, all my colleagues, I always, when we first met as well, it was this question of, do you really live and breathe investments? Because it's obviously a very competitive industry. It's an
great,
industry,
and it's getting even more, yeah.
It's an industry in theory with no barriers to entry. Anyone can set up an investment firm and perform. Maybe some of it's luck in the beginning. Sometimes you're just unlucky.
A little bit of luck.
Yeah. So you do need luck, because sometimes you are right because something went up, but it was perhaps for the wrong reason. So we try and use a lot of the psychology around not trying to think you're too smart when things go your way. But more specifically, in answering your question, it's we try to set out a very reasonable return expectation for ourselves. I think a lot of investors, especially coming off this tremendous bull market all the way from 2009, in sterling terms, I think the funds compounded 11.5% now since 2014, and longer term probably the same. Now that is very high, so if we get to periods like 21, end of 2021, end of 2024, and we perhaps invest at that stage in a way where we have companies that we think can compound at 8 to 9%. A lot of investors would ask, well, why don't you have these super fast growing businesses which can perhaps, which did historically do 25% compound. And that's where you have to be careful. We think we have this massive valuation overlay. Everything that we buy, if you ultimately define the investment philosophy, we are not deep value investors. We're not looking for cheap valuations per se, because that often leads to value traps. So
when you say looking for cheap value, you mean not looking for discounts necessarily?
Yeah, we're not going to go out and buy a European bank because it trades at 0.3 times book. For me, the market's saying there's a problem with that name fundamentally. What we're looking for is a discount to intrinsic value. So we do want to have high confidence in the cash flows of the business, and then we want to put a valuation on that based on a discounted cash flow. And again, discounted cash flow, all these valuation methodologies have flaws because we're dealing with forecast risk. But if we're confident in the path of those cash flows, you can basically summarize our philosophy as growth at the right price. And quality for us is the durability of cash flows. And the durability of those cash flows is a function of the economic moat of the business.
So if I had to ask you, Pieter Fourie, the head of Sanlam Global Equities, is that what quality means for you?
Yes, absolutely. It means, if we think of our biggest position right now, United Health, do we think that as the leading health insurer in the US, that they have the best chance to capture new member growth, that they have the best chance to maintain their higher than average margins because of Optum Health, which is a very good growth driver for the business? And furthermore, do we think that regulations can affect that setup, both in terms of perhaps lack of price increases or just the government getting fed up with so-called deficits?
No, definitely. I mean, I think it's getting to more of the minute detail of the actual global high quality fund and how we get through that process. How does the investment process work? So obviously every fund manager has their own way of, I guess, stock picking. But how do you source the funds? How do you get through the universe of is unlimited amount of funds in the world at the moment? And how do you pinpoint the right one? So how do you start from A and get down to B and C and then basically get the execution part?
So we do have filters, and I think as a quality investor, there are certain sectors that are quite easy for us to screen away. So for instance, utilities. We just think that if you regulate the actual ability of a company to make super profits over time, and we'll get to that concept of what is super profits. I want to use the example of Yum Brands at some stage. And Costco perhaps. So screening away mining companies, banks, and also utility businesses, that's easy for us because we don't think they have the ability to make super profits. They're essentially commoditized industries. If we start with our screening process, so things like high returns on capital, high operating margins, very good balance sheets is part of it. But it's never that simple. If we take, for instance, a company like General Dynamics and United Health, which now have had good returns for us, in their margins on average between 8 to 12% is at the lower end of our overall margin of 20%. But what you find is often that those companies with good solid margins like that, it might not be as high as a Visa, which is in the 60s, or a CME Group, which is also 62% operating margins. But if you have super high margins, sometimes the market's aware that this is a great business, so it might not offer discount to intrinsic value. So for companies with a slower growth profile like a General Dynamics or United Health, how do they end up in the screening process? Because it's the durability again of those cash flows.
It's a strong balance books.
Yeah, so if I showed you a graph of the likes of United Health, 10 years ago, their earnings power, $8 per share. They'll probably make $32 per share this year. So that's a 4 times increase in earnings power. And ultimately, share prices follow the earnings power of a business. It might sound oversimplified, but that's also, of course, what happened to a name like Alphabet that we've owned, basically since 2012.
So is that very much the similar process you follow for all the funds that are allocated in your portfolio at the moment?
Yeah, the good thing is for our model portfolios and for global high quality, and for our model portfolio services, it's just one philosophy. We don't have different models, so that makes also our ability to scale the business very simple. We simply cannot cater for everyone out there. But the advantage of that is that we don't deviate from our philosophy.
On a risk management point of view, because I think that's also a big part of investing, is I guess managing risk. Would you say that the investment philosophy of how you obviously spoke about using discounted cash flows, strong balance books, intrinsic value to the company, how do you manage the risk approach of choosing these funds? Because obviously sometimes the book can look good, the PE can look good, price to earnings. How do you manage that risk?
Yeah, so a good example, a most recent example, if you think about our exchange exposure, we currently have three of them. It's LSE Group, CME Group, the old Chicago Mercantile Exchange, and then Intercontinental Exchange. But drilling down into the detail, each of them are actually quite different. In the following order, in terms of annuity income, LSE is the highest, about 75%, and that's through their stake in Refinitiv that they bought 5 years ago, and which actually caused the weakness in the stock because they probably overpaid in the short term. The stock got down quite a bit. They had some key shareholders over time that wanted to get out. They got paid through LSE shares. And the company was a little bit geared when they did this acquisition, but longer
obviously
term,
you don't like companies that get up, do you?
No, but if you are getting to a level where that gearing reflects the risk in the business, then we do get excited. I mean, clearly a stock like ABI InBev, that company was massively geared post the SAB Miller acquisition. It was, coming back to your question of risk, back in 2008-9. That was one of our biggest positions because they bought Budweiser, and we just had, of course, in March 2009, everything was cheap. I ask investors if they know this concept of shooting fish in a barrel. Now, some of my colleagues don't like that concept, but back in March 2009, it was very difficult not to make money in the market. It was such a low, quality was at a low price. And that still existed in 2012 when I joined Sanlam. But we ended up selling ABI and then only invested back after they did the deal in SAB Miller. So it was still geared at that time, but they have prolific cash flow. They will probably finally be in a position to start buybacks again next year, but it's taken them 10 years to get to this position. So again, what we're trying to do with our screening process, it's you can't always tick all 10 boxes. You can't always have super high return on capital businesses that also trade at favorable valuations. So in that sense, we are definitely not trading orientated, but we can be active in our approach. Last year was a good example. We did quite a bit of switching around of positions. It happened to us in 22 as well. And you when you look back, you'll probably find it's often at inflection points where certain factors dominated and proceeded to us to offer value
that's because I think it's really important that obviously the fund should develop as the market or economic cycle changes too. I think it's obviously, I know, tell me if I'm wrong, but I feel obviously it's a lot of the buy and hold culture that your fund has, right? Capital preservation, long-term growth, for the long run, not for the switching, rebalancing every 3 months. And that's how you get the compound, right? How is your market outlook with the fund? Are you guys very open to, as things change in the economic cycle, so should the fund develop too?
Yes, I mean, ultimately you don't want to be a contrarian per se. You don't just want to step in front of a potential freight train going over you. But if you think about just the last few weeks, the narrative in the market about the US steering towards a recession. So what happened? The credit bureaus, the TransUnions, the Equifaxes, the Experians of the world, less so Experian, but those US companies have been under pressure for a while. And within one of the divisions of Intercontinental Exchange, they do have a mortgage technology division, which is interesting. It's like a software business. So that company was already under pressure 2 years ago on the back of them doing acquisitions in that area, which is what we discussed with the CFO in Atlanta at the time. So we took a long-term view that the cycle probably will struggle. But if we're buying at $105, we have a big margin of safety. Now the stock went on all the way to 170. We think that division alone can grow double digits if it recovers. We don't know when that mortgage market will recover.
We only had a genie ball, a globe ball to do
No,
that.
and the 30-year bond yield have just hit new highs. So everyone in the market knows that the credit bureaus and the mortgage volumes are down. Some people call it generational lows. I wouldn't be that severe to use such a term.
Yeah.
But if there's bad news for a great business like that, that's when you get your opportunity. We were up until yesterday, we were discussing names like Moody's Corporation
Right. Wow.
and S&P Global, because of course, being credit agencies, rating agencies, the issuance was going to get much worse in this higher rate environment. So but ultimately they're great businesses because a lot of what they do is annuity type income. It's not just the new issuance which they have to rate, it's also existing ones that's already in the market. And where's the growth coming from? Well, credit is growing every single day.
It's become a massive trillion whatever market. Yeah.
The US alone, let's face it, at the end of the day, we don't have quantitative easing. But if you're running a deficit of between 4 to 7 billion, the only way to do that is to issue more bonds.
Yeah.
We do it in Europe. The Fed's doing it in the US, or the government in that sense.
Yeah.
So credit is always growing. And for us investing in a company like Intercontinental Exchange, in potential companies like credit bureaus, that you get onto a secular growth industry dominated by a couple of big businesses. That's what we're looking for. Don't try and reinvent the wheel. Just look for really good incumbents where in the very short term there's a bit of negativity on a macro point of view because we're not macro investors, but where we can see the path to growth long term. That's what we're trying to do.
That's it's very interesting. And you said you're obviously not macro investors, but I think macroeconomics, I guess, affects everything in general, right? Policies, monetary policies, fiscal policies. The current economic outlook at the moment, obviously we had Donald Trump yesterday talking about the 90-day pause on tariffs. We've got China hunting for 5% GDP growth. We've got various wars going on in Europe, obviously high inflationary numbers, high interest rates. At the moment, base rates are quite high, obviously not as high as they were back in the 90s or 80s and 70s. What's your economic outlook? And does that have an effect on the fund too?
Yeah, well, I think we are in a high inflation environment. So what does that mean for stock pickers like ourselves? If you are using discounted cash flow, and bond yields are not 50 basis points anymore, but 450 basis points for the ultimate risk asset being US Treasuries, then that's going to put pressure on valuation. So that's why we've become over the last few years a little bit more open, outspoken about return expectations for the market. So when you look at things from the back end of 21, the markets may be up 5% compound. So we did, fortunately a lot better than that. But the reality is we were quite careful not to overpay for companies by the end of 2021. So that will drive our sort of macro outlook, like what discount rates do we have to use? But taking it a bit further, if you think about Trump's announcement yesterday, he specifically excluded China. And in our Chinese exposure, we have companies that, in principle, there's nothing in the business model of Tencent or Yum China that only operates Kentucky Fried Chickens in China. There's nothing that will impact them, but sentiment has been so bad a year ago. So that is why some of these companies have now started to perform really well. So could we have a scenario where the sentiment turns negative again because China is really the only region effectively standing up against Trump and counteracting everything he's doing because they have this huge manufacturing base? Having said that, it's the companies we invest in are not affected by tariffs. So I think it's when we look again, coming back to how we define quality, BMW, Daimler, all these automakers in Europe is fantastically cheap, always has been cheap. but we're not going to buy into a news flow that might or might not improve. It's not what we do. What we're looking for is if there's, as I said, a lot of noise around a place like China, but actually the companies like Tencent is unaffected. And we think it's on a very attractive valuation when we look at a 20-year history.
That's a very fair point. I mean, obviously with the current economic outlook, we're obviously in a cyclical pattern. Obviously, you said high inflationary, interest rates are high. There's various elements affecting macro conditions. Your investment fund obviously has 4 big sectors that's invested in: financials, consumer services, and there's one healthcare and one of the top funds.
Yeah.
Currently now, as the economic, I guess, perspective is changing, is there any sectors you're excited about and any sectors you're, I wouldn't say scared, but you think are quite risky to go into?
Yeah, if I think about our investment trip to the US in May, we were actually surprised a year ago, 10 months ago. Most corporates were actually quite cautious in their tone, which is also interesting for US
very entrepreneurial,
team.
very
Because
go.
Exactly.
Yeah.
I mean, normally a US management team is quite sort of bullish in even at
always,
the worst of times. So a company like Automatic Data Processing, which we bought back in July of last year, that company's gone sideways at that stage for 3 years. So we picked it up at just above $200. And the stock duly moved up to $320. So we know that if there's going to be a recession, it's not going to be great news for a company like that. They do payroll processing, or human capital management is the fancy word. If they employ 1 out of every 6 employees in the US, which they do, we also spoke to their competitor Paychex. So these are great return on capital businesses. They have magnificent pricing power over time, huge retention ratio of core clients, up to 95% retention ratio over time. So we know the news flow is going to be bad, potentially going into a recession. That doesn't mean we're going to sell the business. So it's a top 15 position for us. I think we got in at a very good level. We're going to stay invested. And it's the same with our hotels exposure.
Hilton and the others.
Yeah, I mean, IHG Intercontinental went to £24 during COVID, and you looked rather silly. And then 4 years later, the stock turned at £108, and we actually trimmed the position a couple of weeks ago at that level because we thought it's worth £95. So today at £80, just below £80, we might add to it, but that is about as far as we'll push our macro hat. There's upside in Hilton for us now as long-term investors and for Intercontinental, but at the moment, knowing that the RevPAR number will come down, there's no real incentive for us to add to that position right now. And that's a function more of the overall market is throwing up so many other opportunities for us. I mentioned Moody's. I mentioned a stock like, I haven't mentioned a name like Accenture. I mean, there's a lot of companies that's gone sideways for 3 or 4 years. So we have better optionality right now than to add to our existing positions.
And what about sectors you probably want to avoid?
Yeah, well, I mean, if you think about Europe and, by the end of March, the notion was...
Would you include UK into that as well?
Yeah, I mean, everybody started talking about this great rotation. Now, within the first few days of April, you just had massive pullbacks in most European markets because I just think there are just many more quality companies in the US. And ultimately, they're all multinationals too. They earn a large part of their income from outside the US. So it all comes out in the wash. But I think if we look at the really great businesses like Louis Vuitton, it's been terrible underperforming now for 2 years.
The holding group, the LVMH.
Yeah, it's a great business, but we think we can wait. We can wait in L'Oreal. L'Oreal has been sort of stuck at a very high valuation level for over 5 years. It is a great business, and cosmetics within consumer staples is probably the best growth area out there. But we still don't think the margin of safety is quite there yet. So for European quality investors, I think it's a tough market. We've done really well out of SAP. 3 years ago, it became one of our top positions. It went as high as 7% in the fund. But it's moved from €80 to 250. And the beginning of this year, we halved the position just because we thought it's worth 220. But it just shows you how the narrative can change.
Shift very quickly.
Yeah, within the granolas, that one was the standout performer. My colleague, William, who covers it, did extremely well. We had huge debates 3-4 years ago whether he perhaps isn't modeling too rosy an outcome. Today, a lot of the sell side is doing just that. They think that the company's guaranteed to grow top line and bottom line between 10 to 15% over the next 5 years. The only problem is the valuation
doesn't look
at 250 now reflected that. And that's where the valuation overlay comes in for us. Where can we assess that the good news is now also reflected in the share price? Whereas on a relative basis, now we clearly getting interested in Louis Vuitton, because the company, the US has started to turn down, which is a great cash cow for them. The news out of China is still not improving. So sentiment's poor, relative performance is poor, and it remains a great business. It's got good margins, 18-odd%. It's got good returns on capital. It is the best managed business in the luxury space, but you have to be very careful if you're going into a recession with names like that.
I know, because obviously that the fixed consumer price index and pockets, and people don't have enough money to spend on luxury goods. Obviously, we're in quite a really interesting economic cycle. There's been a lot of panic recently in the last 2 weeks. We've seen the stock market take big dips, and today it's kind of gone up again because of various, I guess, political factors. Being a fund manager, and you said, you touched on the active aspect of it. Do you have quite a big difference between what you think on passive and active investing? And what's your thoughts on that? Because obviously passive at the moment, I think most of those portfolios would have taken, a big hiding, but a big dip in the market. And obviously this is now when, if you're an active manager, this is where you put proof to the pudding.
Yes, I think it's the timing is very fortunate for us having this conversation today. I mean, as you mentioned, we've outperformed MSCI World. So at least over 11 years, we've proven that there are active managers that can outperform. The strategy itself has opened up the gap between MSCI World and the average fund. So yes, I'm absolutely a believer in active management. If we take the Mag 7, we invested in 2 companies. We've owned Microsoft forever, so that's been a great investment for us over time. And then Alphabet we've owned for 12 years. So in the sell-off, we were adding not to Amazon or Apple, but we were actually adding to Alphabet. So we think, we did that back in September at 150. The stock got ramped up to 200 in mid-December, and we then trimmed that position again. And today we have been buying again at $150 level. And we'll wait to see if it gets to our intrinsic value of $190. So it all depends on what the market, the opportunities the market throws up for us. And just another example, so we've been buying into Intuit. If you think about the environment 3 years ago, May of 22, within that first 3 or 4 months of the year, the market lost a substantial had a substantial drawdown, and suddenly from big euphoria end of 2021, in the space of 5 months, you saw a company like Intuit go from $700 to $380, and they did make a mistake with Credit Karma, which they bought, and they probably overpaid, and then the credit cycle turned against them. But we made that investment at about $380. It then went back up to close to $700, and we trimmed that back in September of 23. Wow. Today we are buying the company around $600 again at the same valuation as 3 years ago, and we think it's got a great runway for growth. But that's a good example of what we do in terms of Visa, in terms of Intercontinental Exchange and Intuit. There we are paying an ADP above market multiples for what we believe to be truly great long-term compounders. And then against that, we have companies like Heineken and United Health, which we think are slower growers, but they don't deserve to be at a discount to the market.
Can I ask, if you don't mind, obviously the audience that's listening probably will have good knowledge of some, I guess, financial acronyms and wordings. What is the big difference between active and passive, and why are you for active rather than passive?
So if we look at a passive investor today, going into the beginning of this year, about 25% of your investments would have been in the Magnificent Seven. So
The heavyweight allocation.
yes.
Yeah.
So if we take the most obvious example, Apple, and I didn't know at the time that Trump was going to be so convinced about his views on tariffs. But if you take the iPhone, which ultimately is very important for Apple in terms of overall profitability, if these tariffs went through the way he said a week ago, then the iPhone would be 60% more expensive to assemble.
The sales would have dropped.
Yeah,
massively.
and obviously Apple can't pass through a 60% sales increase to their customers. So the stock was down 30%. So if you've got a 5% position as a passive investor in what used to be a very well diversified index, MSCI World, then you were looking at paying 30 times cash flow for a business that essentially was over earning quite a bit based on the new tariff legislation. So if you are a passive investor, why would you invest in Apple at 30 times cash flow when we can build a portfolio of 25 names trading at 20 times cash flow, where we believe the growth over time can be just as good as Apple from a very, very high base? I mean, they're just $420 billion of sales. It's just very difficult, the law of big numbers, to grow from there.
What do you think of this whole passive bubble?
I mean, is it a bubble? I think where it becomes dangerous, if you hear terms like granolas and terrific 10 in China, and you hear, Mag 7, and you then start seeing things like 3 times, 4 times geared. I listened yesterday to a youngster who said to me he's invested in a gold ETF, which is 20 times geared. So I said to this individual, are you sure about that? I've never heard of that before. It means that if there's a 5% drawdown, you lose all your capital. He says, yes, my mum said I'm crazy. But, this is where we think the world becomes dangerous, when you have very specific ETF products that target a very specific niche market, and you add leverage to that. Of course, the famous single stock leverage as well on names like Tesla. If you're in a bull market and price momentum's going your way, it's very difficult as an active manager to then say, you just buy these very good blue chip companies and you expect a reasonable return. And I think for passive investing, if the big drivers of past performance are now very big parts of the constituent and they're very expensive, it could well be a dangerous environment. But the proof is in the pudding. If we look at the last year, we are substantially ahead of the market. Year to date, before yesterday's rally, we were 10% of the head of the market. So it's up to the active industry to prove what they're saying, and that's been very, very tough, where returns have been dominated by the Mag 7. But I think in an environment like this, funds like ourselves can hopefully prove that there is indeed a place for active management.
Would you say, obviously, if you were a retail investor choosing to invest their funds or their capital into either an active or passive portfolio, what advice could you give them in that point of view? Is it a hedge? The reason you invest in active is because it's a hedge against downfalls or withdrawals?
I think it's, the passive industry has obviously made a big song and dance about fees. I mean, it is true that if you only pay 10 basis points now, as one of my friends eloquently put it, is also a fund manager. If you're down 15% this year and you pay 10 basis points, ultimately, if you're an active investor and you lost less money, as we did 10% less, then hopefully you pay for a lot of active fees over time. But since inception is the important thing for us, can you show value? Can you show outperformance of the market over time? If you also measure yourself against an index, I think passive investors, there's still other costs involved, platform fees, the fees itself. So comparing yourself to an index, you should probably compare yourself against a tracker, which will already improve your relative returns, because you can't just buy an index for free. There's always frictionary costs. So I think if someone is saying, let's buy the S&P 500, it's been the best performer for 20 years, it all makes sense, let's buy it at a low price. You have to ask yourself if you're buying value. Are you buying that index at a discount to intrinsic value? Now, we have enough evidence to suggest that based on certain measures like price to sales, price to book, price to earnings for that matter, that the S&P is at a dangerous point from a valuation point of view. And that's why we're not keen on passive investments right now in the S&P 500 specifically.
If you don't mind, if we just, I guess, conclude the active and passive in very simple terms, what is active, what is passive?
So active is when you have 25 names instead of 4,000. Active is when you have a sort of active share like we do of over 95%, and all that means is that you look very different to an index. You behave very differently to an index. We in the massive drawdown that we saw last week, when the S&P lost, I think 5 or 6%, we had our single biggest day of relative outperformance of 290 basis points, which I never thought I'll see in my investment career. So can you behave differently to an index when it matters most? I think, unfortunately, the same thing probably happened yesterday when the S&P went up 9.8%. I must admit, I'm seeing things today that I never thought I would see in my investment career.
Wow.
And I think the problem with the world is information is freely available. Price momentum is still a huge factor driving retail investors, and that's a very dangerous potential place. If price action is the only factor driving investment decisions as opposed to fundamentals combined with valuations, that's why we're so bullish on active management right now.
And that probably plays in as well, I guess, with the younger audience as well, in instant gratification, instant satisfaction, social media, a lot of, I guess, investment gurus and all the rest. I guess our generation, we want to see, instant gain, not just sit on the money for 10 years and then only or 20 years. We want the money now. We want that, I think that's why a lot of people probably go into future or leverage trading, because there's a bit of that bet against the market. You can potentially make, big winnings, but you could lose in a matter of seconds too. Talking about the current economic cycle, I guess people probably went crazy in the streets when all the tariffs went down. It was like mania. What do you do to stay disciplined when the market shows a lot of red everywhere? I think we saw the Bloomberg terminals and it was just red everywhere.
Yeah.
What do you do to stay disciplined in that moment?
I think if we take this year, as you know, the year actually started quite strong.
Yeah.
And when we saw the first rotation into Europe, we actually saw some big gains for some of the names that have not been great performers for us. So, and I want to make it clear in this podcast that we do make mistakes. And I think it's important as a fund manager, if you can't admit to it and also get out of names that haven't worked, then you certainly haven't been, in my opinion, you haven't been around the block long enough. So we had, on the back of China, we had some very strong rallies in names like Kering, and we got out of most of the position at much higher levels than where it is today. So the fundamentals still remains quite challenging for that business. So we made a mistake in that one. But we also started selling names like Roche. A lot of the defensive names like that started to move tremendously, and that was before Trump started talking about slapping on tariffs for farmers as well. So we have been reducing over time our names in pharmaceuticals because we're just not comfortable with that industry looking long-term at patent expiries and our comfort with cash flow forecasts.
You've obviously been since the dot-com bubble, 2008 financial crisis, and the oil crisis many years ago as well. So you've seen the market dip and rally and all the rest. So would you say you're much more proactive than reactive?
Correct. That is a fantastic summary. You have to. We lean against trends when that trend is earlier this year. There was definitely a defensive trend where a company like Yum Brands we've owned, and it's covered by my colleague Louis, covers Yum China as well. we've owned that for over 18 years in the strategy non-stop. But there are times when we owned both. And there were 3 times where we exited Yum China because the stock moved from between $25 to $65. That is a massive range of 300%. We were active buyers of more Yum China back in June of 23 at $40, and we looked stupid for a while, but now it's looking a lot better. So with Yum Brands, what suddenly happened in the US market is the narrative changed from let's look at very strong US businesses. Let's look at this concept of let's make America great again. Well, maybe it's being challenged. So now we want to have businesses like Yum, who announced that within their international operations, they're going to aggressively target over 4,000 new stores in Taco Bell.
Which will be great for, I guess, earning reports once that goes through, yeah.
And so suddenly investors were looking for international stocks in the US that had international operations. And for Yum Brand, a lot of their growth will come from emerging markets, specifically their relationship, their royalty arrangement with Yum China. So China, Turkey, and India, great growth stories for them. And Taco Bell will be part of that.
Wow.
And the stock moved from $110 to $160. So suddenly from doing nothing for us for a couple of years, it had that big move, and we took out 1% of the position at 160, just thinking, well, we can add to Intuit, we can add to Applied Materials, and we can add to Alphabet. So that's where the active management comes from. We are now looking at technology companies, and we're looking at more financials. I mentioned Moody's Corporation, S&P Global, some of the credit bureaus like TransUnion. So within financials, I think you also got to be very careful. Bloomberg has reclassified a lot of these industries into financials. So Fiserv has been a great long-term winner for us now. Visa as well, which we added to 3.5 years ago. But they're not banks, and they're not insurance companies, because those companies can be obscure.
Definitely.
From an accounting point of view, but they used to be classified as technology. So I want to make it clear on your question earlier about how we invest from a sector point of view as well. If we add up a company like ADP, which in our opinion is a tech business, but it's classified as an industrial. And when we look at Visa and Fiserv and companies like CME and Intercontinental Exchange, they are financials, but they're not subject to the credit cycle. They're not subject to bad debts.
Very important that you mentioned that.
Yeah, they're trading orientated. So when you ask me what's my view on a cycle, we ultimately always invest in anti-cyclical businesses where possible, because we're not good at trying to time entries into mining stocks or banks. And I think that is the risk for Europe. Is that my hats off to those deep value investors who invested in European banks at the low. But if we do get into an ugly economic cycle, I think the jury is out whether those will ultimately be great compounders. And I've got very strong views on that they won't be.
That's I think you hit the nail on the head on the whole active and passive route as well. And I guess the economic outlook, because obviously you said you're not really trying to follow the cycles. And that's what passive does, doesn't it? It follows the trends.
Correct, yeah.
Thank you, Peter. That's been brilliant. Regarding advice for youngsters, obviously there's going to be a lot of people are going to obviously have watched this, and you've given big perspective on the fund, how it's managed, how you think as an individual going into the industry. If you want to become a asset manager, is there any guidance you give young individuals who want to come into the industry? Obviously you do the CFA route and the CA route.
Yes.
Is there anything you would do differently 30 odd years ago, 40 odd years ago?
I think you need to find someone to speak to. But the first thing I think is also, if you want to be an investor, do it for yourself. So the very simplest advice is, if I say to people, you want to be an investor, I said, do you have a savings plan? So, I remember at university, getting I was fortunate enough to get some bursaries. I kept some of that money aside and I started investing for myself. There's nothing that makes you so focused than trying to figure out why would you invest in company A and not company B. And for my sons, I invested in a gold mining stock when I was at high school, and I cured myself of that disease forever by losing a lot of money.
Yeah.
So that taught me that buying bad businesses will give you a bad outcome, but you can also buy great businesses and overpay for them.
So you touched on the point on kind of dabbling in investments yourself. What about qualifications? Obviously, the world is changing. I don't think there's as many numbers of people going to universities. It's very easy to do, I guess the ChatGPT and the access to online documents is so easy to take in information now. Would you say people should still go down the same route as university, or?
Yes, I do think that it's a good solid background. And I've got this interesting story when I studied for accountancy, and I did really well in my first year. So there was no problems from an academic point of view, but I gave the results to my dad, who was then the dean of the law faculty. And I said, Dad, I'm not enjoying what I'm doing here. And he said to me, but Peter, this is an academic institution. It's not supposed to
Be fun.
It's not supposed to be fun. It's academic in nature. But the plan is to give you this solid background. With regards to the CFA, I think it gives you even more ability perhaps to show that you can apply your mind and because it's a tough thing to pass, but it's not the end all and be all.
In other routes,
I think the most important thing is passion. Can you find the Costco's of the world? And it's a fantastic business model, and Charlie Munger spoke about it a lot. We think it's very expensive, but as a customer, he summarized it as it's a fantastic example of doing something extremely simple very well and then making obscene amounts of money. So it's to find the edge and how you define something to be a great business. Going back to my analogy many, many years ago, I remember buying into Checkers ShopRite at the time at 1 Rand and went to 3 Rand. And I thought I was very clever. Today it's 300 Rand. So the concept of not thinking that after you've doubled or quadrupled your money that a great business can't continue to have fantastic performance. A name like Yum Brands, when you talk to people about Kentucky Fried Chicken and Taco Bell, you're not going to be the star of the party. But when you say to investors, if you invest in 98, you would have made 25 times your money, of which a large part is also the reinvestment of dividends. So basic concepts like that. What does long-term growth actually look like? Often it's perceived as boring way of compounding. And Buffett said, compounding should be boring. It's buying those great businesses where it's not the 4 to 6% growth in a single year that gets you excited. It's the ability to do that for 30 or 35 years, which creates this compounding effect. And, in our presentations, we have a graph of Yum because it's one of the stocks that we've owned forever, along with Microsoft. And that gap between itself and the index has just widened now. Compliments of this pullback in the market and the stock reaching new highs.
Yeah.
But the function of how that happened is because the cash flows kept growing.
That's a very valid point. You spoke about when you were Stonehenge, you had a mentor.
Yes.
That you worked underneath you. How important is having a mentor when you're starting out your career? And let's also then talk about the points of curiosity, as in, when you're investing when you're younger, and then the resilience as well. But let's go on the mentorship aspect first. How important is it as a young individual?
Yes, so Giuseppe Ciuzzi is the CEO, still chairman of Stonehenge today. He taught me a lot about business as well. I mean, in terms of being a good investor, you also want to have a good business. And that means paying a lot of attention to your underlying investors, having close relationship, having a mutual trust. And then, of course, looking for growth opportunities, but never let the commercial side drive the investment decision-making process.
And what about looking up to them? As in, what do they do different that you took in as I guess as the mentee or the person below them that you could look up to and go, wow, they handle relationships well, they thought differently, they wake up at 6 a.m. every morning to go on the grind or whatever it might be. Is there things you take away from a mentor?
I think the important thing is, I have this great story about us meeting 6 o'clock on a Monday morning because he couldn't find any other time. And there was another colleague there still with Stonehenge. And it was just one of those great meetings because he had to summarize a lot of meetings he had the previous day. So the reality is mentors, the good mentors, I'd be surprised if you have a mentor and that mentor is not hardworking. So clearly,
Look up to.
big successes come from very hard work. So we do work hard as a team. We're proud of the $1.5 billion of assets we have, but without exception, it's our underlying investors that ultimately is that success. So we do make sure that we go back to our investors and remember those investors who will obviously invest with us over time. We want to make sure that there's very clear communication to them and that we're very honest about both our successes and the odd failures that we have in stock picking. But if you have a very open relationship like that, you're probably on a good path.
And Peter, obviously, you live and breathe being a fund man. Everyone probably knows you as Pieter Fourie, head of Global Equities, but you're also Pieter Fourie, a parent, a friend, a father. What is your switch off out of work? We spoke earlier, you can't switch off. You love thinking about stocks and stock picking, and the market is your best friend. But what do you do outside of work that switches you totally off or tries to switch you off?
Yeah, I mean, I have a client who's actually an anaesthetist, and he wrote me a WhatsApp just last week saying, so keep exercising, because in your job and in mine, it's important not to
get the mind to go wild.
So I do gym to try and keep fit. I love golf, especially my days with Giuseppe was great because you saw a bit of the world and you played very nice courses. So that's a way to switch off. But I find skiing is probably the best thing to switch off, because
very extreme.
Yeah, I like skiing because it caters to different needs. You can be a social skier, or you can do what I did last week and you take on some sort of big off-piste slope, and you have to really concentrate and test yourself and also know your limitations. Are you in control or are you out of control?
And how comfortable do you feel with that?
Yes, you never want to be out of control. And it's the same with our investment. Do you really understand what you're doing? Do you believe in what you're doing? Or are you just drifting?
No,
are you just an index hugger? Yeah. So I think from a playing tennis as well with my kids are very nice. They tell me I'm not good enough now. So that keeps you motivated.
Keeps you humbled as well.
Yeah. So yes, I think having your health is super important.
I guess mental health is a big part of it as well, right?
Yeah.
Because obviously you've been in the industry for quite a few years. And obviously I think it's very easy to sometimes take things quite literally in the head as well, where it can affect you personally, it can affect you at home, it can affect you whatever it might be. So it's good to have that balance, like you mentioned.
I think you're right. It's when the market's against you, it can be quite a lonely place.
Because you live and breathe investments. That is what you are as a fund manager.
Yeah.
And I think it's very easy to get lost in that too, isn't it?
I think colleagues and family, they can see when you're not, as much as you try to hide it, they can see when you're not in a happy place. But it's also extremely important to us to be very humble when you are doing well. That's when when right now is when we're working the hardest to try and figure out if we are not just momentum investors at the moment in a good place, and whether we're still doing the right thing for our investors. But yes, you need, I wish I could sleep better. I must admit, I don't, I'm not the best sleeper. Never have been. The moment I wake up,
So what's your routine? You early riser? Do you go to bed quite late?
No, I'm a morning person.
And once you wake, you can't go back to sleep.
Yes, and then I
love a coffee.
Very much
love a coffee.
Yeah. I love a coffee. I do try to go to gym every day at 6 o'clock, and but it does mean that I sometimes fall asleep from the TV at 10 o'clock as well.
That's okay.
Very, very naughty
That's
habit.
Okay. What about any additional, I guess, podcasters or thinkers you look up to, or books you read that someone can take away from this meeting?
I listened to an interview of Bill Nyron the other day from Oakmark Investors, or Harris Associates as they're known. And I mean, I read a lot of documents from people I've met in the industry and people that I rate. I have a lot of friends in the industry that I guess are also competitors, but we all think of ourselves as learning. Well, I certainly read fact sheets from managers that I believe have done really well long term. I've one of my best friends work at a very big firm, I try and soak up everything I can get from other managers, because if we have a position and someone else has a different view, where could we be wrong?
What
Where
are they
could
thinking that you're not thinking?
Yes,
Yeah.
and so the information, we live in a fantastic era where this information is so
It's accessible.
freely
Yeah, accessible.
accessible,
Yeah.
but you have to filter it down. So within the 30 funds that we look at, what we think does the same thing as us, reading about what they think, and then when you see some investors buying at points in time names like CME or United Health afterwards, just after you've done it as well, it gives you some comfort
justification.
That, yes, well, at least that the pond that you're fishing in is the same for those investors that have great long-term track records as well.
If there's, I guess, one takeaway, and we'll get to that point, who are the role models in the industry you look up to or have looked up to?
Gosh, I mean, when I was young, I read about, I read Peter Lynch, One Up on Wall Street and Beating the Street. I mean, obviously, I've listened to podcasts from Anthony Bolton and those sort of really fantastic investors. But in the UK, if I look at people who are very purist in terms of quality, obviously Lindsay Train is someone that has been very pure to his philosophy. I've got great respect for him.
And what about Warren Buffett and Charlie Munger?
Yes,
late Charlie Munger.
What I like about Warren Buffett is he, in his newsletter, he always has basically one or two messages each year. And, the message to me this year in simple terms were, I don't like bonds. He talked about all this cash that he's been building up, and
it's only one of the top is, I think, he's the only billionaire in the top 10 billions in the world that's made a profit this year.
Yes. I mean, the Berkshire's up, and so he's saying the market's expensive, but I'll be very quick to buy something if there's he's looking for a pullback in the market. So what do I like about Buffett is when he says the same thing every single year at his conference, but just in a different way. And, market pullbacks are good because market pullbacks improve the return expectations of our investors because things are now cheaper. But as Buffett says, when things are for sale, nobody wants to buy. It's the only industry in the world where when things are for sale, nobody wants to buy. And when things are expensive, everybody wants to buy. So the role model is more in terms of keeping those 5 to 10 principles of certain investors and reminding yourself that those simple advice, those are normally the best advice.
I guess a closing reflection. If you could, obviously, I'm going to summarize the whole podcast, I guess, or discussion, but if there's one, I guess, key takeaway that you would want listeners to take away from this conversation, what would it be? Maybe can't maybe this conversation or point to young, old, middle age, whatever it might be as listening. I guess a few key takeaways.
Well, first of all, if you invest, go and buy a great business. I know it sounds really, really obvious, but great businesses often are monopolistic in nature. They're very well positioned long term for growth. Don't start off by looking at cheap valuations. Normally, when something is cheap, it's like a second-hand car, it's you're going to end up with the thing breaking down. But also very importantly, don't just be a momentum investor. Don't just think because the whole of the market goes up that it's always the case, especially, going back to indexation. So many of those great businesses perhaps are over earning at the moment because they've done so well. They're almost a victim of their own success. So please don't disregard active management. There is a way to invest in 25 to 30 names, which hopefully over time that concentrated portfolio makes sense because you understand those 25 businesses really well.
And personally, for people that are undertaking studies that want to go into investment banking or go down the asset management route, any perseverance you can totally give them?
Yes, I think it's, for me, starting at StoneEgg all those years ago, there was nothing as well, just as we had no assets 12 years ago with Sanlam. Be humble, be hungry, set yourself realistic targets. Don't be greedy financially. If you do the right thing, this is a great industry to be in. because you can change people's lives financially. And of course, if you're hugely successful, there will be financial rewards as well. But that has to be a function of you doing the right thing.
And the hard work.
Yeah, it's there's too many people, I think, in our industry who wants instant gratification.
Yeah, chasing the money.
It takes time to build a track record and to demonstrate that you care about your investors.
Definitely. Pieter, I greatly appreciate your time, and thank you for coming on the podcast. I have learned an incredible amount myself. And I think that I love about these podcasts is that I speak to such unique and specific people in different industries, that I almost take the analogy of being a sponge, right? And just soaking up knowledge as much as I can. And I hope the listeners or the audience as well as watching this can, take that same analogy, because that's really what it is, right? It's just almost just soaking up knowledge as much as possible and taking the good and the bad out of it and applying it to yourself. But once again, Pieter, it's been an honor.
Thank you, Jordan.